Hello, good morning. We have reached Wednesday, May 22nd, and the dollar has reached the highest level since 2002. At least if we look at the trade-weighted basket. We can just start off with the chart here just to give you an idea about this continued climb higher. We've seen relatively stable dollar now for almost the past year against the euro, but it is moving, it is grinding higher, and just take a look at some of the G8 currencies on the right there. You can see there's broad-based gains of the dollar against most currencies, with the exceptions being Canadian dollar due to the strong oil prices, and also the Mexican peso due to its carry. But really, a stronger dollar, Peter, it's not what the world needed at this stage.
No, as we've talked about many times before, it's very negative for global growth. The dollar is arguably global money, and especially after the financial crisis, the Fed is the global central bank these days. And whenever we saw, and you know that back in 14 and 15, when there was a sharp acceleration in the US dollar, it was very bad for emerging markets, and we're seeing this sort of the same picture today, and it also have implications for commodity prices and others, you know.
Yeah, we got a table just a little bit later showing that, but just staying with the currencies, another currency which is down against the dollar and which dropped again yesterday is sterling. Take a look at the chart here. May came out with a press conference, and she had some news to tell us, and the traders heard the word referendum being mentioned, and sterling jumped back above 128, and but very soon they was shot down in flames by members of the parties on both sides of the aisle. It basically means that May is staring at a defeat now at the early June vote. It's the fourth in a row, and the speculation in the market is most likely that she will resign, and we shall call election in the UK, because there's not enough new in this latest attempt to sway some Labour voters to join her for the deal. So sterling is back toying with these recent lows. Staying just finishing off the dollar theme, with the dollar being so strong as we've seen, one market that's actually doing reasonably well, even though it's not doing much, is gold. Take a look at the chart here. We are testing support once again, but we have to remember the dollar's influence on gold. Dollar goes up, gold tends to go down. We have seen this rally in the dollar not having such a negative impact on gold this time around. Obviously, because during this past few months, we've seen bond yields come lower. We got a Fed which is potentially moving towards easing instead of tightening, and also just this whole trade war worries that's currently engulfing the market. But Peter, let's move to the overall view, because we just brought this table here, which just gives an idea about where the losses have been so far this month. And this is the dark blue, and you can see general losses apart from if you were long the long end of the US yield curve. But the biggest losses, EM stocks and semiconductors.
Exactly, yeah. But also you can see the Kospi, you have South Korea there as well. So it's the markets that are sensitive to the trade war. It's the markets that are sensitive to a strong dollar. It's the markets that are sensitive to slowing economic growth. And we have all three catalysts hammering at full speed here in markets, and I think that's the result. But it's a dramatic move we have seen in semiconductors. And if you take the next slide, we've created this monitor because semiconductors are the epicenter of the US-China trade war. So if you look at the chart to the left, the semiconductors industry can be broken into two parts. So there is the equipment makers, and then there is the raw semiconductors. So the raw semiconductors is the orange line, blue the equipment makers, and the gray line is the MSCI All Country World Index. And as you can see here, it's dramatic underperformance this month, and this is something that we're going to monitor, because if you see a bounce back in or a strength in semiconductors, that could be a positive sign for the trade war talks. If this divergence and underperformance continue, it's a dire sign. The right chart here I think is quite interesting, because it shows you we have broken the raw semiconductors into their geographies based on where the companies are. And as you can see here, the yellow line is actually Greater China semiconductors, and they have actually outperformed all the other geographies, with only Japan and Taiwan doing a little bit better. But European and US semiconductor makers are really hurting at this point.
Potentially to a certain extent also driven by the fact that Chinese stock market so far is still one of the best performing markets up until recently, at least. So there's been money has to be placed somewhere in the.
And as we've thought about, there is a lot of support coming from the Chinese government. Hence, what we're saying, the best way to express a negative view on the trade war is doing it indirectly via oil, via the dollar, yen, the South Korean equities, and also other equity markets around China. I think it's a much better way to reflect the negative view on the trade war if you have one.
Talking about growth, yesterday we had the OECD out once again downgrading their growth forecast. It's now down to, global growth is down to 3.2. It was downgraded to 3.3 last month, so they continue to reduce. And we had also Fed's Rosenberg yesterday out also sounding the alarm about this trade war and its potential impact on the US economy. And we did see some reaction in some of the commodities, especially oil, but I'll just take that a little bit later. But with all this, obviously there's still a lot of money in the world. We got increasingly bond markets moving into negative yield territory once again. Investors are looking for liquidity, and I suppose that's moving to the US.
Yeah, exactly. We have been looking at the trade war using what we call the trade war basket, where we back in January 2018 made a basket where you're long US equities and then you're short all the key 5 countries with the biggest trade surplus against the US. So it's China. If you look at the chart, you can basically see the trade basket here. So it's China, it's Mexico, it's Japan, it's Germany, and then Canada. And as you can see here, US equities, this basket has outperformed these deficit or these trade surplus countries with around 20 percentage point. And even in the latest spat, an acceleration, escalation of the trade war, as you have seen here, US equities have actually outperformed with 10 percentage point in a very short time span here. So as you said, I think it's a safe haven, I think it's liquidity, but also the US current policy seems to be on the margin, at least judged by the market, being more negative for the trade surplus countries than the US.
But I gather from the next chart, Peter, you're not exactly prepared to jump into the market just yet.
No, I'm not. This is just a chart on the Nasdaq, just to give you some perspective. We had it the other day as well. There was a little bit of risk on coming in yesterday's session because of that reprieve of the Huawei ban. But this morning again, there's new targets. We'll talk about that in a few seconds. But as you can see here, technically we are very weak. And if we break down below the recent lows for within the last week, I think we'll go down and retest those lows. I think to me it's still staggering that we are at these levels in the equity market, especially also the S&P 500, given the deterioration we have in the trade war and the strengthening US dollar, which will just add further drag to the global economy. I'm really profoundly bewildered by the price action we're seeing in US equities.
And we also see we are trading a tad soft this morning, even though this carrot and stick approach, which is being applied both by the US and China right now, was in full show yesterday when the Chinese, I believe the Chinese ambassador in US, he basically was out saying that there was still a good chance of a deal, but and they were prepared to talk, but the market's not really buying into it. And you mentioned, Peter, that there's some additional talk about additional companies being targeted.
Exactly. The flip side of that positive comment from the Chinese diplomat is news today, both in the FT, that US companies are already now, facing several issues and retaliation inside China. Is already pulling back some manufacturing and also investments in China. And I think that's a key thing here. So when the US went after CTE and also Huawei, they did it with a big PR splash. They made it very specific that we're going after Chinese companies. But in China, they're doing a little bit more in stealth mode. So it could be a missing container, you suddenly lost your slot in the port, etc. So it's all these day-to-day frictions that are happening under the surface. And then also the US has is now willing to put Hikvision digital technology, one of the biggest technology companies in China. They're also now being considered putting on the blacklist of the US Commerce Department, and that's just a further sign that this technology Cold War that we have been talking about is happening in front of our eyes, and I think it is the starting signal of something major here.
So keep an eye on these semiconductors and these technological companies. Just staying on, moving to commodities, as I mentioned earlier, we did see those the Rosenberg yesterday sounding a bit of a warning signal about the U.S. economy, and we're also actually right now seeing the forecast for Q2 growth being downgraded. Now it's now below 2% from close to 3% a couple of months ago. So the expectations are being downgraded. But crude oil didn't really like what they heard, because we've seen this now the past week. We've had a lot of unrest concerning the Middle East. but the market hasn't really moved higher. The market's not really buying into. They cannot see any political reason for Trump to enter into a military conflict in the Middle East at this stage. He likes the high stock price and he likes low oil prices, and these two he's not going to get if we see this situation escalate. So the market's not buying into it, and we're seeing the market drift lower. And if we now start to once again focus on the demand or the lack of demand or slowing demand, then that could obviously add some pressure to the downside. So we are evenly poised here ahead of the EIA weekly report today. And as you can see, the API last night, they came out with some numbers which went against what the market was surveyed to look for. So we're looking for API basically reported an increase both in crude oil stocks and gasoline stocks. If that's being confirmed this afternoon by the EIA, then there is a risk that this uptrend since December could be challenged, and we could be looking down towards the 57.30 level, which is the first major retracement level. So a lot of built-in, or the market's basically not buying this elevated risk right now. So and of course it could obviously very quickly come back, but at the same time the worries about demand is starting to weigh on the market. One we take a look at from time to time, coffee. It had a bit of a spike yesterday. Peter and I have been discussing it from time to time, also taking Starbucks into the consideration. But we did see a market jump a bit yesterday. Obviously, looking at the big downtrend, you can hardly measure it. But there was some news about some frost potentially hitting some of the higher regions in the key growing area here on May 25th, and also we did see the Brazilian real strengthen a bit after having been weakening recently. So the top right corner you can see the speculative net short with the orange line. It's not as short as when we had a record back in October, which helped drive this 25-30% spike back then. So this time round slightly different, but just keep an eye on this 95 level.
But as we talked about so many times, because of the way the futures curve is, the shape of the futures curve in coffee prices, you typically historically have seen when you have price moves to the upside, they're more violent than to the downside. So I mean, this could be potential. I think it's worth looking at as a trading opportunity whether this have some legs, some more momentum over the next couple of weeks. It does,
because a lot of investors are basically just rolling the curve. They're selling themselves short to roll it every month to gain a recovery or gain a return, because you're selling the expiring contract cheaper than where you buy the next. That means that there is a lot of speculators in there who will obviously be keeping a close eye on the technical outlook. And again, from that perspective, 50% or 50-day moving average is one of the keys. But I think 95 cents, which was the old floor, and then briefly top as well. Just keep an eye on that. Right, Peter, let's just move into the calendar. I think the main event today is FOMC minutes later this afternoon. But if we take a look at it, we have Draghi also speaking in Frankfurt this morning. We got UK CPI, retail sales from Canada, and then, as I mentioned, the weekly inventory report. But the FOMC meeting minutes tonight, I don't know if you have any comments on that one.
The expectation is not high for this meeting. It'll probably be mostly plain sailing. They might make some few changes in the wordings, giving small hints and guidance of where they see the policy moves. But I think the Fed is very much in a wait-and-see mode at this point in time. They might point out the recent weakness that we have observing in the U.S. economy, and maybe changing the language a little bit more to the downside risk of the U.S. economy. So it could be potentially interesting, but let's see. I think the probability for them turning a little bit more dovish is higher than turning hawkish, at least. That's for sure.
That's what it looks like at this stage. Okay, so we'll finish there. We will be back again same time tomorrow. But again, the dollar at the highest level since 2002. It's probably the one we should keep an eye on for the potential impact across markets. Thank you very much.